Welcome to Realty Success Hub, your daily show for all things exciting in real estate. We've got a phenomenal show for you today. We've got a couple of wonderful guest speakers from different parts of the country. I would like to introduce a couple of them to you right now. We have Brooke Bryant out of Charlotte, North Carolina. Hello, Brooke.
Hi, Aaron. I'm so happy to be here today and talking about all things real estate. I am Brooke Bryant. I'm a realtor in Charlotte, North Carolina, and the surrounding areas, and also have the pleasure of co-hosting the show with you, Aaron. And also, I've written a book. It's called The Ultimate Guide for First-Time Home Buyers. And it's a sort of a from start to finish process of if you're thinking about buying a home till we get to the closing table and even beyond. So excited to be here. And I'm so happy that you're joining us, Angela.
Hi guys, I'm Angela Brown. I am with a company called Savvy Cleaner. We train house cleaners and maids. We are in 191 languages in 37 countries. So we are the first and the last people before you buy or sell a home because it's got to be cleaned. So we're going to talk about cleaning at another time. Today we're going to be talking about syndication of real estate. And I'm really excited. Please, Jim, share with us about a little bit about yourself and your business here.
Yeah, absolutely. My name is Jim. I received my Bachelor degree of Science in Economics from UCLA back in 2010. As many of you guys may know, that's right after 2008 subprime mortgage crash, followed by the 2010 European debt crisis. So it was really difficult for me to find a job back then. But I was fortunate enough to land an inside sales role working at LoopNet. Now, for those that don't know what LoopNet is, it's basically Zillow for commercial real estate. And so through that, I was able to gain experience by talking to real estate investors, property managers, lenders, agents on a daily basis. And I learned the importance of real estate investing and never looked back ever since I took upon that job and became a real estate investor full time since 2015.
Wow, that's fantastic. Thank you so much for that intro. Could you tell us a little bit about syndication? I know that's what you specialize in. Could you give us just a little bit of background into what syndication is and how you got started in it?
Yeah, absolutely. So a little bit background about what real estate syndication is. It's a partnership between investors who pool their resources into a single investment. This allows you to invest in multi-million-dollar deals like multifamily properties or commercial buildings. Syndication eliminates much of the risk while sharing in the upside. The property generates an income that will be split amongst investors. It's a win-win scenario. How I got into it was that back in 2020 during lockdown, I used to be a realtor. From 2018 to 2020, I tried to make a career out of it. Wasn't good at it. Wasn't a good fit. So in 2020, one of my investors introduced me to a podcast show called the Real Estate Guy Radio Show, and on the show they pitched a lot about doing bigger deals, easy to scale. At that time, I didn't understand what that means, and they kept talking about syndication. So and then as soon as we opened back up, I went out to network with these guys, educated myself about syndication for about a year, met my business partner for another year, and finally syndicated my first 2 projects last year.
That's exciting.
Good for you.
Yeah. I know a lot of. Oh, sorry. Go ahead, Brooke.
No. So I was just going to say, so real estate is the syndication side of it. So you've got really expensive properties, like you said, multi-million-dollar properties. So is that would you say for investors it's more of a long-term investment than a lot of real estate investors are doing flips or those sorts of things? Is syndication a long-term opportunity?
Great question. Yes, it is. Typically, in a syndication, we project the whole period to be 5 years. So once you put your money into a syndication deal, your money's stuck there. It's illiquid. It's not like stock market. You can just come in and out at any time and cash out. So we project 5 years because it's a very conservative measure that we can double your money in 5 years. So if you put in, let's just say 100,000 into a deal, at the end of the 5 year hold period, we we can sell it and get your money back plus 2x your money. So basically, you'll get 200,000 back on top of the passive income you would get
Wow.
yearly.
So my question is this: is this kind of like a timeshare, but instead of it being a timeshare where you go on vacation, you then end up owning a piece of property with other people that you're all sharing kind of the same pocket of wealth?
You can say that in a way. What I what I like to break down to people is that syndication. I think a lot of people mistaken syndication as REITs, and REITs is very different than syndication. Like to give you an just like full snapshot of it is when we go out and source syndication deal, multifamily deals, right? What happens is that we put the deal in an LLC, and then everybody would invest into that LLC. So depending on how much money you put into it, that you get a piece of the equity of that LLC that holds the real estate. So all the tax write-off gets passed through the investor, depending on the percentage of ownership you have of that LLC. So that's basically real syndication in a nutshell, how it differs from REITs, because REITs, it's a stock, it's a share. You don't own a piece of the equity of that real estate. You don't know what type of real estate that they're putting into the portfolio. It's a mix and match of, retail, strip mall plaza, office, just a combination of in different markets. You don't know. You're just buying a share of the company, basically. But with syndication, you know exactly what you're getting yourself into. You know where the property is located, how many units it is, and all the operation that's currently being run by the LLC, and so it's very, very clear in terms of what you're getting, and you're getting all the tax write-off. So that's the big difference.
What does that mean in terms of management and say, let's say I put $100,000 into a syndication with you. Um, is it totally managed by a third party? Um, what kind of oversight? Like help our viewers understand what that would look like.
Yeah, absolutely. So in the syndication, there's a lot of moving parts, right? So you have typically the syndicator, they're also the operator. So they're the ones that, so as me as a syndicator, there's a lot of roles in the syndication team. There's people that help raise capital, do investor relation and marketing, and that's more my role in the syndication business. Whereas there's other people on the team that are doing more on the operation side. So what they do is called the asset management. Asset management is basically managing the property manager that's going to manage the whole facility, making sure the tenants pay on time, making sure the work orders are up to date and maintenance are taken care of, the amenities, adding value to the property. Everything has to be aligned, right? If you're doing some construction and evicting tenants, that's all part of the operation that the property management company has to figure out and how to manage the whole thing. But that's just another piece of the component. Another piece on the team that someone needs to have is, let's say, loan guarantor. So when we do bigger deals like this, let's just say a 10 to $30 million deal. Well, let's just say if it's $30 million deal, LTV is going to be what 20 million. So in order to be able to sign off on such a big loan, banks require what's known as a key principal or loan guarantor. So someone needs to have that kind of net worth to be able to sign off that loan. So that's another piece of the component. So there's like a lot of moving parts. And in my first deal, we have a total of 6 general partners on the team. In my second deal, we have 8 general partners on the team. So it depends on the deal.
So when you say general partners, is that investor? If I'm an investor, I'm called a general partner.
No. So as an investor, as a passive investor, you call it limited partner. General partners are the people who manage the deal, and we get paid based on the performance.
And as a limited partner, do they have a voice in any of it? in any of the properties that you select, or how the property is being managed, or are they more silent?
They don't, because they're just investing passively. If you want more of a role, an active role, and more have a saying in it, then I would suggest going into a joint venture. Joint ventures are deals that's like, smaller size. You can probably get away with less than 10 people, but every single person on the team must have a role. Because as soon as someone becomes passive, then you have to comply with securities law, SEC. Otherwise, you'll get dinged for it.
All right. So I know all of you guys know about real estate, and I'm new to the real estate nuances and what have you. So walk me through from beginning to end. Like, let's say that I was interested in syndication, but I had no idea where to start. Like, walk me through a scenario. You come to me, we have a conversation, and then like, how do I get involved?
Yeah, so I would say the first step is definitely to educate yourself more about the space. I think a lot of people mistaken real estate as get rich quick scheme, which is actually the opposite around, right? The other way around. It's a get rich, build wealth slow game that you're playing. And so with real estate syndication, the true downfall is definitely your money is going to be stuck in there forever. So number one thing is making sure that you have enough money so that your money is, once you invest in a syndication, you can't just take it out. So make sure that that's not your emergency money. That's why I always tell people, if you're not at a place where you have extra money to invest, don't even consider it at this moment. And so that's number one thing, to educate yourself and kind of know if this is the type of deal you want to get yourself into. Number two is that it really depends on what you do, right? With what you're currently good at. So I can give you an example of why people like syndication is because it's you're investing passively. You can still focus doing what you do best. Let's just say you run a cleaning business, right? You're really good at doing it. Nobody can compete against you. You're the top 1% of the nation. Well, why would you give that up and start doing real estate syndication? And so I see a lot of people in our industry where business owners, entrepreneurs are very successful, but they see, the shining objects, which is real estate syndication, and they want to be the operator. But you don't necessarily have to be an operator. You can just invest passively into deals. And so that's number two. You got to figure out whether or not, if this is something that you like to invest passively into other people's deal, or do you want to run your own deal, right? That's all what it comes down to. If you want to run your own deal, that's great. You can start, you can be active in however you want. But yeah, so those are the two things. And I would say once you get familiar, once you educate and you feel comfortable investing in a syndication, the last part is just finding an operator that you trust. Because as you guys know, in this industry, whether you're an agent, whether you're a syndicator, it's all about building that trust, building that relationship. And I can tell you that I have a list of 300 investors on my list, but majority of them are just speculating right now because I just started, right? So nobody wants to be the guinea pig. They're just speculating to see how I'm doing and how my deals are going and so forth. So it does take time to build that relationship to gain trust of all these investors, and it's a lot of money. It's a lot of money. It's not something that you can just throw away. So I understand.
So if I was new to investing in syndication, how would I know if it's a good deal or not?
All the deals are structured pretty much the same way. The main thing is, well, I guess the one thing I can tell you is, like, if you were to go into a race, would you bet on the jockey or the horse, right? That's the question. For me, you would bet on the jockey, because that's the most important part, because you can have a really good deal and a really bad operator operating it, and then the deal is going to go really bad. But if you have a bad deal and a really good operator, the really good operator is going to make the deal, better, right? So that's the way how our industry works. And so that's why I stress heavily on the operator, finding the right operator that you trust, because if they don't have the track record and the experience and the team to back up everything that they do, then it's not going to work out. It's not going to work out. I'll give you an example. Like right now, with the economy conditions that we're in right now, a lot of deals are going under the water because interest rate has just gone up, 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 and it's crushing all of us. And right now, and the best way I can put it is that what Warren Buffett's quote says, "When the tide goes out, you'll see who's swimming naked." So that's what's happening in our industry right now, because people over leverage. Back in 2020, when trillions and trillions of dollars were printed, everybody was borrowing for really cheap. But now, if you over leverage, that's when you need to have those tough conversation with investors to put more money into the deal.
So, Jim, it sounds like it's all about having the right team in place that are finding these deals out there. Somebody comes along, they want to invest, they're a passive investor. So they're just handing you a lump sum of cash, stepping back and saying, you guys take care of it for the next 5 years. And we'll, see what that looks like at the end of 5 years. Is that correct?
Yep, that summarizes it pretty well. Right on point.
Fantastic. So it's all about finding then, if you've got money, it's all about finding this team that's got a great track record, that's looking for these phenomenal deals in the market, and putting these deals together. Is that the case?
Yep.
And this is what you guys specialize in. You guys have a really good team, and you guys take passive investors in.
Yep.
Correct? Okay.
Mm-hmm.
So, as far as finding the deals, it's very exciting. Would love to hear all about how you guys find them and the type of deals, but also for our audience, I know they want to know specifically how to invest with you as well. So, is there like a typical buy-in for each deal? So, let's say you've got a 300-unit complex. Is that a different buy-in than, say, a 250? Or is it kind of a base across the board on what people are buying in for?
Yeah, so our strategy is we target Sunbelt states, anywhere there's sunshine, and typical, if there's a migration pattern, population growth, which leads to job growth, which leads to income growth. All that is good signs of a market that's worth investing. We also look for, business, political, landlord-friendly states. I can give you an example. Back in 2020, when I met my business partner, we had a plan to syndicate a deal out here in California, but due to eviction moratorium, tenants stopped paying, and we wanted to mitigate that risk for our investor. That's why we outsource deals out of state now, where it's more, landlord business friendly. And plus, during lockdown, Florida was completely open. So that was another thing. That was another reason why we chose Florida to invest. But there's pros and cons of investing in each state. You just have to kind of balance things out, because in Florida right now, insurance have gone through the roof, right, due to hurricanes and stuff like that. So it's
Across the
not.
board, yeah, insurance has gone crazy this year.
Yeah, and same thing in California. Some properties out here, they won't even insure due to wildfires, and so it's getting kind of absurd. So yeah, so those are the matrix that we look at when we look at these states. We just go where the deal goes. We don't necessarily just focus on Florida, even though both my deals are in Florida right now. We look at places like Texas, Georgia, Carolinas, Florida. Those are great markets that we like to invest in. And then in terms of how many units, we like to target 100 plus units, because that's where the sweet spot is. That's where you're not competing against too many mom and pops, but then you're just on the borderline of competing against the institutional deals, right? And so I think that's been a good sweet spot for us. And the reason why we target value add is just like you guys mentioned at the beginning of the show. Value add gives that the fix and flip component to it, where we can renovate units, we can increase the rent, and then bump it up to market value. And then once the commercial property price is dictated by the income it produces, as long as we can increase our bottom line, our NOI, we can sell it for more. That we're confident we can sell it for double the price in 5 years. So yeah, so that's basically why we target value add. It's more aggressive. But there are deals out there that targets no value add. That's Class C, Class A apartment buildings in downtowns, newer build, cash flow first day right off the bat. So it just depends on the deal that you're looking for and in your risk tolerance.
So you mentioned building those relationships, which you're right. I mean, that is so fundamental in real estate. And Angela, I'm sure you can attest to it too in your business. It's so important to build those relationships. So while you're doing that, and you mentioned a track record, like what should, if I were an investor, what are like some of the key financial indicators that I can look at to think, okay, this is going to be a good project for me to invest in? Jim, I trust you with this. What are like some of the key financial factors to let me think, okay, this is a pretty good investment opportunity?
Absolutely. So I would say, if you educate yourself about syndication and you start to look at deals and you look at how each syndicator is underwriting deals, then you'll be able to pick up things really fast, right? Like, so for example, the rent increase due to inflation, because of rent, because rental real estate kind of hedges against inflation. When there's inflation, rent goes up, right? So if you look at a syndicator that underwrites a deal that he's putting 10% increase year over year, that's a red flag right there, right? Because historically, rent bump has been consistently 3%. That's where the inflation usually lies. So if just because in between 2020 to 2022, Florida's rent has gone up like 20-30%, doesn't mean it's going to consistently go up that high, right? So those are the little things, the little details you can look for. But the track record you're talking about could be something like a syndicator who's already exited some deals, right? And that's really important to. I know a lot of my investors, the reason why they're speculating is because I haven't exited any deals. So that takes time. That takes at least 3 to 5 years for me to be able to refi projects or to be able to sell a project. So you look at that and you check out what are the percentage, what are the IRR, the annualized return that the syndicator is able to provide for their investors, and what did they promise their investors before that, like at the very beginning of the journey, right? Because anybody can project 8% pref, 70-30 split, 2x equity multiple, which is 200,000 back your initial 100,000 investment. But at the end of the day, who can get you there faster, right? Because at the end of the day, investing in a real estate syndication, it's all about releveraging your capital as well. So as soon as we can return some of your capital back, let's say in year 2, year 3, after we renovated a good amount of units, and we're able to appraise the property and then cash out refi, return some capital to the investor. It's about returning that capital to you guys as soon as possible so you can releverage that capital and reinvest in other deals. That's what it's all about, right? And some deals, even though we project 5 years, some deals we can end up selling it in year 2, year 3, depending on the market condition. If the market is really great, let's say back in 2020, I've seen some syndication that they hold it only for 1 year to 2x money, investors' money back. So it depends on the market as well. It depends on where the syndicators end up choosing the market, if it aligns with your interests. I think ultimately you have to also look at if your interest is aligned with the syndicator's interests. That's one thing that you'll hear from a lot of people.
So my question for you is, let's say that I invested some money and I wanted out of the deal. And I know you said you can't get out easily because your money is tied up for a period of time. If the time is right, how does one get out of a deal?
If you absolutely need to get out of it, and you didn't hear this from me because every deal is different, right? So that you have to check the fine print of every deal. So what happens is that you can actually ask the lead sponsor, which is the head of the syndicator, for an exception. And what happens is that then they will sell your share within the group. But it's a headache for everybody, and that's why I'm just letting you know up front. There is a way to get out of it, but some syndicators, they just flat out tell their investors, no, it's not gonna, we're not doing it. So,
Well, the reason I ask is what happens if, say, an investor, one of the investors of the syndicate, it becomes deceased or something? Then what happens?
oh, if that's what you mean, okay. So yeah, so that goes past down to whatever will and yeah, any if you have a written will or anything that's someone's supposed to inherit it, then that's what it comes down to. It's all written on there, and you can on that you can dictate your own terms.
So if the let's say that it was my father, for example, that invested, and then I inherited the shares, but I didn't want in the deal, could I get out then?
Yeah, yeah, absolutely. At that point, there's that discrepancy, you basically can work with the syndicator. Hey, I wasn't planning on working. I wasn't planning on investing this deal. I just want to get out. I just want to cash out, and they'll work with you on that typically.
I'm assuming that it'd be a smaller rate of return if you're dipping out early, et cetera, based on where the deal is at. Probably somebody within the company would be buying that out, correct?
Yeah, so you might not even get your returns if you dip out
Yeah.
early.
Okay.
Yeah. And to give you more detail about that, right now some of the deals we have what's known as a capital call, which means that we need to inject more capital into the deal, and some investors are not happy with that, but it's just because of the market condition, right? Everybody is going through these challenges, and so if an investor decides not to put more money into it, their equity share gets diluted, right? And so, and whoever ends up putting more money into it, their equity would increase, basically. So that's basically how it works. It's pretty simple, pretty straightforward.
Are there some good tax advantages to investing in a syndicate as opposed to other types of investments? Or what is or maybe even you want to talk about like the exit strategy when you do get those returns? What does the taxation of this look like?
Yeah. So I can give you an example of my first deal. I think on so basically once you invest in a syndication deal, I put 100,000 of my own money into my first deal, and I got a negative 39,000 of depreciation on my K1 the first year. And my best friend, he was able to get, I think, 12,000 tax credit back from investing syndication from just putting 75,000 into the deal. And it's the way it works is that the first year typically we're not going to make any distribution, even though we promise you 8% preferred return. What preferred return means that if we don't pay you out that 8% first year, it does accumulate the next following year, right? Until there's a liquidity event such as cash out refi or selling the property. So typically first year we're going to come out as a net loss due to renovation, due to eviction, due to just depreciation. So you'll get all that tax write-off passed through to you. You can get that tax write-off as a real estate professional and write it off against your ordinary income. If you're not a real estate professional, you can have it write off against your passive income. Now, don't quote me on that. Just check with your accountant on this. And so that's basically how it works. And so, and then we also have what's called cost segregation. I don't know if you guys are familiar with that. Is where either you hire an engineer, you go into the building, and you pretty much accelerate, depreciate things that's in the building. And so so that's why you'll get the pretty a good chunk of tax write-off in the first couple of years. And then when we do sell, there's recapture, but there's always a way to get around that by 1031 exchange, as you know, as a realtor. That's another option to continue to get tax write-off and not pay tax.
Well, and a lot of people might not know what the 1031 exchange is. So can you just touch on that for a minute?
Yeah, 1031 exchange is basically where you have an investment property and you want to sell it, and all the capital gains tax that you pay, you have to pay. You can avoid paying that by basically finding a new investment property that's equal to the same value of the property that you just sold or higher. Right? If the next property is priced higher, then you're good. And once you buy that next property using this money, you don't have to pay any tax. So that's basically what 1031 exchange is. But you have to identify the property, I think, in 45 days or something like that, and then you have to execute the 1031 exchange within 6 months. So there's a deadline. That's one thing that I've encountered, is that a lot of my investors miss the deadline. It's really hard to identify the property, sell the property, and then finally transfer your funds into that new property. It's a process. So just be aware there's deadlines.
So you mentioned that somebody that would be a great syndicate purchase investor person would be somebody that has, let's say, extra cash sitting around.
Mhm.
Who is the perfect person? Like, who's the target audience for a syndicate deal?
I would say high net worth earners, doctors, lawyers, business owners, people that are always looking for ways to park their money. They're so busy working, making money. What ultimately what they want is get their time back. They have enough money. They can make a lot of money. But now it's more of a time versus money now. Do you want more money, or do you want more of your time back? And that's why these high net worth earners, they're always looking to figure out ways of how to get more time back by investing, by putting their money into work, so they don't have to work as hard and have more time to spend with their family. And those are the type of audience that I've encountered a lot recently.
I almost feel like we need to back up just a little bit for our viewers, and just talk about the different classes of this multifamily real estate in terms of investment and the risk tolerance. Is that something you could maybe touch on a little bit between A, B, and C, and why you guys choose C and that over B and A?
Yeah, absolutely. So we chose C because I just started, and the reason why I also chose C is because I have I've been surrounded, like I told you guys, I started my career working at LoopNet, then I transitioned to become a realtor. So I've always been dealing with real estate my whole life, and
Mhm.
I have a list of contacts where I have a lot of fix and flippers in my life, and so I see that that they're doing well, and everybody's very successful. The only thing I don't like about fix and flips is the tax event, right? You have to pay a hefty tax once you fix it, flip it, and within a year. And so I believe in holding real estate for as long as I can. I've often hear people say, people that's like older than me in their 60s, 70s, they said that they regret. So one thing they regret about real estate is selling when they don't have to. So right.
Mhm.
So to give you why I target these more aggressive, more risky assets, because I figured, well, I want to be able to hold something in long term, but I also want to be able to create value. through the asset class. So I was basically thinking about how can I combine fix a flip with long-term holding. So I like the idea of being able to add value, but I also like the idea of holding it long-term. So that's why we chose to target value add Class C apartment building.
And can you tell us why it's more risky, a Class C?
Oh yeah, absolutely. So Class C, the reason why it was more risky is because typically it's you have deferred maintenance. That's the biggest one, right? Yeah, it's built in 1970s. There's a lot of deferred maintenance. You don't know what you're getting yourself into sometimes. So this could be upon taking over the project, then you'll start to see a lot of problems. But before
You're
then,
also inheriting all of the current leases and all of these things in place, correct?
yes. Yes, absolutely. And that's why earlier I mentioned, you're not going to get any distribution the first year because typically in the first year, upon taking over the project, because of ownership has switched, tenants are going to move out. They don't like the new owners for whatever reason. We still need to evict tenants due to bad debt, right? And then so there's like all these things moving pieces. And so occupancy rate will go from 90% down to 80, 70%. That's why there's no distribution. It takes time to stabilize that property in the first year, right? So that's usually how it works. I'm not sure if that answers your question.
No, that absolutely did. And then could you just briefly touch on what B and A is for our audience so that they understand that kind of the difference in classes of real
Yeah.
estate?
So when I mention A, B, and C, C doesn't necessarily just means deferred maintenance, but it also depends on the location too, right? When you guys talk about real estate, it's about location, location, location. That's why earlier when I mentioned Class A is in downtown because it's the most convenient. You have access to the stadiums, the city, and so forth. And so when we talk about A, B, and C, it's not just the year the property is built, but it also depends on the location the property resides in, right? So Bs are typically more like closer to the city, but in the suburbs, but it's growing. It's got a lot of amenities around. It's in a desirable location, and it's built probably after the 80s, 90s, newer built. Class A would be something that's like completely new construction, built after 2000s, in areas like downtown, the prime area, and so forth. So that's usually how they differentiate between A, B, and C.
So I would think one of the advantages of, and one of the draws for getting investors into syndication is that real estate is a much less volatile investment than a lot of others are. But there's risk with everything. So, I mean, and God forbid we have another 2008, but what would you consider to be a risk in syndication, something to look out for?
Yeah, I can definitely talk about that. And this is something that people don't want to hear, but I'll be upfront with you guys. So earlier I mentioned there's a capital call in my deal, right? So that's something that everybody wants to avoid. And to go back to answer your early question, Angela, one thing that a lot of investors look at when you look at a syndication deal is what happens if I put in the money and I don't get it back? There is that risk, right? And what happens if the deal needs more money? And there is that risk as well. And that's what's happening right now in this market condition. It just puts us in a tough spot. In my first deal in Orlando, 200-unit apartment building, we are on point. We renovated 90% of the units already. Our occupancy rate is at 94%. You cannot get any better than that. However, we're still upside down negative 10,000 cash flow every month. Why? Because our interest rate has gone up from literally 4.7 or 4.9 up to 9%. And that's on top of the rate cap. Rate cap is an interest rate that it's like an insurance that we buy so that it doesn't exceed a certain threshold. And we bought rate cap for hundreds of thousands and our interest rate is still at 10%. On top of that, insurance costs had nearly double in Florida. the combination of all this kind of just puts us under the water for a little bit. It's not too bad. So going to your question, there is that risk, right? That it's out of our control, no matter how great we operate our deals. However, these are the times that we know that if our operation is running smoothly and we can get to 2025, we can survive to 2025, we're golden. So the capital call basically is just getting our investors together and basically asking them to contribute more, inject more capital into the deal, because if we're upside down negative 10,000, we still have to pay the banks back, and we don't want to go into default, right? So right now, this is part of the risk, and the way I look at it is that it creates a lot of fear in a lot of investors. But the way I like to look at it is I look at it optimistically, as in like, I myself as a general partner, I'm gonna put in my own share of money into it, right? I'm taking that risk. Now, a lot of investors might think they're throwing good money at bad deal, right? That's the fear that everybody is going through right now. But in reality, if our operation is running so well, if the lead sponsor, which is the lead syndicator, he has $3 million of his own money in the deal, it's saying something. There's like a lot of signs where this deal, if we can make it to 2025, we're gonna cash out, and I'm a big believer in that, and so I'm definitely going to contribute my own share to put more money into it, because I see the big picture, right? You have to look at the big picture and see that, okay, is this deal going to do really well in 2 years, and is this just because of the economics condition that's putting us in this spot? So that's a risk, right? That you have to kind of figure out, are you willing to take on that risk? Even though it sounds good, yeah, you'll double your money in 2 years. I mean, 5 years minimum. And then you'll get the 8% passive income, which comes out to be, about 28% annualized return. It sounds good on paper, but at the end of the day, these are the, things do happen in real estate. So it's out of your control. You just have to look at it on the bright side. That's what I like to say.
So speaking of the bright side, I'm one of these people where I like to plan for the worst. And then if something better than that happens, then woohoo, something better happened. But let's say, suppose that I dumped a lot of money into a syndicate deal, and then one of the parties in the deal declared bankruptcy. What does that do to me as another investor in that deal?
When you say another person,
one of the investors of the syndicate.
Oh, one of the investors, but not the general partner, but the limited partner. Is that what you're saying?
I'm not sure of the term, but let's say a bunch of us went in and we pooled our money together and we bought a bunch of properties, and then one of the parties that had a lot of the money invested declared bankruptcy halfway through the deal. What does that do to me?
It doesn't affect you. If they're a limited partner, it wouldn't affect you at all. But if you're talking about the general partners, then at that point, what's going to happen is that we're going to source out other general partners to help out, because there's always options. So in order for us to default, a lot of things has to happen, right? Meaning we have to exhaust a bunch of different options before that we allow that to happen. Because at the end of the day, no matter what, our mission is not to lose your money, and not our money as well, because our money is also in the deal, right? And that's another thing that you should look for in a syndication deal is invest. When I say have their interests aligned with the syndicator, is invest in deals where the syndicators have their own skin in the game as well, right? Where they have the money in there. So if that was to happen, to answer your question, what we would do is we would source out a different lead sponsor, or more a general partner to come in to work with the team to help us manage and navigate through the deal. If that doesn't happen, we can source out private equity groups, right? Private equity groups they're treated as banks, and they just loan you money, and you have to pay them 12% interest. And then after that, there's still options of working with other banks. So there's definitely a lot of options that you can explore before the whole ship sinks down and Yeah. So, yeah, I don't know if that answers your question.
It does, and thank you for answering it. So my question is that how do I safeguard my own money going into a deal, knowing that I'm not going to be able to take it out for 5 or maybe 10 years? How do I safeguard my money, knowing that it's going to be a safe bet?
Yeah, so again, this it all comes down to whether you trust the operator or not at the end of the day, because that's what it comes down to, right? Are you getting? I think the biggest part, what I'm seeing in my industry, is that a lot of people they miss out on the communication, and I think communication is important, especially during bad times. When you deliver bad news, it builds trust, and I think that's a lot of people they kind of overlook that. But those are the
But
tough.
I would rather not have that kind of conversation or communication.
Yeah,
I
yeah,
don't I don't
I
want the
understand.
bad news.
I understand, I understand. But I mean, like, like newsletters, right? Communication, like, as in, like, how often do your team communicate with you? And that's number one thing. When you go into a deal, it's yeah, sure, you don't have much saying in the deal, but you want to keep an update of what's going on in the market, what's going on with the project, and so forth, right? So if your syndicator is constantly communicating, sending newsletter out, calling you once a month, once every quarter, that's good sign. That means they're really just informing you what's going on, and keeping you update. Like with my investors, I tell them, look, I know you want your distribution the first year, but that's not happening, especially in this market condition. And that's just how I am with my investors, just being very transparent with them, letting know, hey, we're working our butt off to make this happen, and we have our own money in the deal as well. We're just trying to preserve our capital for as long as possible. So yeah, so I think that's important to make sure that you always get an update from your syndicators.
Well, it definitely sounds to me, Jim, like it's all about the team, and it's all
Mhm.
about the person's level of um, maybe risk. So depending on the type of the property, whoever is investing, whether it's an A, B, or C, obviously C being a little more risky,
Mhm.
than B or A. And, again, it goes back to that team, their experience, and really relying on that team to make sure that they can get that deal done over a long period of time. And it sounds like the team's communication with the silent partners is also really important. Um, that being said, do you guys rely on banks at all for an infusion of cash if the silent investors or silent partners can't come up with cash calls in an economic situation like we're having now, where interest rates are higher, loans are harder to get, et cetera? I know these are typically funded by the individual and not necessarily banks. Who do you guys rely on for that influx of money if it's not coming from the partners?
Yeah, so just like you mentioned, it's coming from the bank. So right now, our option, like I mentioned earlier, with one of our deal at 9%, we're figuring out ways of cashing out. I'm not cashing out of refi into a different loan, because the loan product that we had got ourselves into is bridge loan. Bridge loan, interest only, yeah, variable interest, and that's what's killing us, right? So
Mhm.
we're trying to refi into an agency loan, which is more fixed rate for the next 5 years, more stable at 6%. But in order to do so, we would have to basically cash in refi, not cash out, but cash in, to put money into it, and then so we can refi into a better debt. And so that's why we're having this capital call, is to get that refi so that we can survive to 2025. And to answer your question, if the capital call doesn't end up happening, if the people can't contribute, then we look at other options. Like I mentioned, private equity. There's still options out there. The problem with going with other banks, adding more banks into the deal, you know how that goes. The
Oh,
capital
yeah.
stack. Yeah, the way how it works is that we pay out the banks first, and then the equity investors, right? The people that invest into the deal, and then the general partner. General partner gets paid last. So if the deal does not perform, we don't get anything. So that's why it's to give us incentives to make sure that the deal performs. That way, everyone wins.
So I think I've got two questions. One question is, as a general partner, so you get cash when you have when you sell, you get your portion of the distribution. Is there also a fee for you that you get paid as a sponsor or a partner for this, for running the syndication?
Yeah. So the way how we get paid is acquisition, disposition, refi, and sometimes construction fee. But that doesn't happen in my deals. But acquisitions is basically 1 to 3%, depending on how big the deal is of the purchase price. That gets paid to the general partners team. Disposition is basically just selling it. Refi is just cash out refi. We charge 1%, and then another big one is asset management. So asset management is between 1 to 3% of the monthly revenue that's coming in through the projects.
So is it super stressful what you do running the syndication? Yeah.
Yeah, you can say in this market, yes. In this market condition, because of just high debt costs, high insurance rate, it's no matter how you run your deal, you're going to be under the water. And then but I see, again, it's the way how you look at things. I see that as an opportunity to be able to invest more into this deal, just because I know it's going to. We're in this Orlando deal that I'm in. It's a very strong market, strong population growth. Upon taking before taking over the operation, our average rent per unit is $850. Upon taking over it, it's at $1,000 a unit, and now it's at $1,350 for the renovated unit. So you can tell it's a 55% increase on rent. So I have no doubt this deal is great, and it's I call it Class C building, but it's actually in a Class A neighborhood. Again, it depends on the location, but because the building is really old and has a lot of deferred maintenance, we categorize it as Class C. So we pretty much did everything we can to bring it up to Class B. Now we just have to wait until the market changes and we'll sell it.
So I've got a quick question for you. I know that you're in California and the property that you're focusing on right now is in Florida. What kind of preparations do you have to do to buy something clear across the country from where you live?
A lot of networking, a lot of relationship building. So we don't have a team, like both my business partner and I, we don't have a team out there, but we do know the lead sponsors. He has boots on the ground out there. He's been doing deals out there for about 10 plus years. He's syndicated probably 4 projects out there in Florida. So very familiar with the market. He has a team with him. The reason why he's able to renovate 180 units out of 200 units in a time span of 1 year is because he brought his whole crew. Like, I think he has about 10 contractors or something, or a list of vendors that he just moved them to that project and basically renovated throughout the whole year. So he has a great team set up out there, and it's through my business partner's network that we're able to find this guy. And we've been seeing each other from at real estate conference from time to time.
Do you guys run your own property management teams, or do you guys outsource that?
Good question. So a lot of great syndicators, like successful ones, they do what vertically integrated. They have their own property management company. Right now, we don't. We hire a third party, but we hire one of the biggest. I forgot what they're called, but they have $2 billion under asset management. They were terrible because they didn't have any presence in Florida. They just opened a new in the market, and so we like to hire someone that has very local presence. Some property management company that's strictly focused on Orlando, if our deal is in Orlando. So after switching property management company, it's doing much better. It's a lot better. But yeah, that was also one of our challenges.
So I guess it's going to depend on the deal and if you're eventually going to bring that in-house or not, as far as property management on deals.
Yeah, I mean, if you have enough deals where it makes sense for you to create your own property management company in that market, yeah, I would say, especially if all your deals are concentrated in one area. But
Hmm.
that doesn't always happen, right?
Yeah.
Yeah, if you can make that work, that's great.
So, if I'm interested in getting involved with syndication and becoming an investor, how with the people in our audience, how would we find you? And do you have any tools that can help people educate themselves on this process and learn more about it?
Yeah, they can visit my website, formosainvesting.com. Right there, there's an ebook for them to download. And yeah, there you go, formosainvesting.com/download. And I basically wrote a short 10 pages long ebook, kind of talks about my journey from working at LoopNet to become an investor, 2-bedroom, 1-bathroom condo investor to multifamily syndicator. And the things that I learned and all the mistakes I made so that you don't have to make them. So I think those are short read, very straightforward, simple. And yeah, and then they can also connect me on social media, LinkedIn, Instagram, Facebook, Twitter, at Formosa Investing.
Yeah, we have all
Syndication.
of your social media and in our show notes as well.
Okay, thanks.
Sorry, Aaron.
No, I was just going to say syndication is such a fascinating world. Is so exciting to get to talk to you about it and um, just the process that you've been through.
Yeah,
So,
hopefully it was helpful. I know I know I talk a lot, and I'm not sure if I'm answering all your questions, but if you guys would like to learn more, I can add all of you to my newsletter, and it basically just talks everything in more detail about what syndication is.
well, we
Yeah,
appreciate
that'd
you
be
so
great.
much.
I'm always ready to learn.
Yeah,
Okay.
thank you.
Yeah.
Hey, Brooke, where do we find you on social media if
So,
people want to learn more about you?
yeah, so if you're in the Charlotte, North Carolina area, or if you have anybody moving to this area, I'd be happy to help. I do love working with first-time home buyers, but work with investors and home buyers and sellers of all type. And you can find me on all my social media. Ask Brooke Bryant. And this has been great. I've learned so much today.
Well, thank you, Brooke. Appreciate it. And Angela, where can we find you?
I am at Ask Angela Brown on all of the social medias. You can also find me on YouTube if you just do a search for Angela Brown. Of course, you're going to find the great big screen behind me with all the cleaning chemicals, and we're going to teach you how to clean. So before you go into your next syndicate deal and you spend all the money and you buy all the properties, make sure you know how to clean them. Because if you're going to get that money raised, you got to make sure that people are moving into nice, clean apartments. So thank you so much, Jim, for your time today. And thank you guys for including me.
Really appreciate you guys. Thank you so, so much.
And
Thank
Aaron,
you.
where does everybody find you?
Oh, right. Ask Aaron Brown. You can find me on any of the social medias, of course, and on YouTube under Ask Aaron Brown. So
This was fun. Thanks, Jim.
Yeah,
really
absolutely. Thanks for
appreciate
having
you
me.
guys. Thank you so much.